Stablecoins have been in the spotlight over the last few weeks, and for all the wrong reasons. Regulators are starting to get nervous about the impact stablecoins could have, not just on the crypto market, but on the financial markets as a whole. This is because the total market cap of all stablecoins combined currently stands at more than $100 billion and counting. This wouldn't be a problem were it not for the fact that the issuers of these stablecoins have not been very transparent about the assets which back their dollar-pegged tokens. Now this is a problem because if everyone went to cash out their stablecoins at the same time, there's no telling what could happen. As it so happens, some of the largest stablecoin issuers recently revealed this information, and we now know the assets that back the three largest stablecoins in circulation. Today, I'll be taking a closer look at the three companies which issue these stablecoins. I'll analyze the assets that back their tokens and explain what implications this could have for the crypto market. Not so fast. There's a disclaimer I need to broadcast. Financial advice is great, but all I do here is educate. That's because I'm not licensed to help you with your dough, so talk to a financial advisor if you need help with your cryptocurrency portfolio. If this is your first time stopping by, my name is Guy and crypto rules my mind. The Coin Bureau is home to some of the highest quality crypto content you'll ever know. Coins, tokens, news, reviews, tutorials, and more. If this is the sort of stuff you crave, subscribing to the channel and pinging that notification bell is the way. If you're short on time, those timestamps in the video timeline should help you get by. Just know that if you watch the whole way through, it will help this video get found by others like you. So now that I've covered my ass, let's take a look at the three largest stablecoins and how they're backed. To quickly recap, stablecoins are cryptocurrencies that are designed to mirror the price of a regular fiat currency, usually the US dollar. Before stablecoins existed, traders would have to send their crypto, usually BTC, to a crypto-to-fiat payment gateway whenever they wanted to capitalize on a gain or cut their losses. This was not very efficient because moving between crypto and fiat often incurred a lot of fees, and a busy blockchain or exchange could mean losing some of your gains or deepening your losses due to delays and downtime. Stablecoins make it possible to cash out without actually having to convert your cryptocurrency into fiat. Trading against a stablecoin also makes it much easier to calculate your gains and losses. This is why stablecoins are so popular, and it's also why most of the trading volume for any given coin or token comes from stablecoin pairs. Generally speaking, there are three types of stablecoin: fiat-backed, crypto-backed, and algorithmic. All of them ultimately maintain their dollar pegs by adjusting their supply based on demand. When demand for a stablecoin is high enough, this can push its price above $1. This usually happens whenever the crypto market is dropping like a rock, because everyone is rushing to buy stablecoins to protect their portfolios from further losses. Eventually, new stablecoins are minted to meet this demand and restore the dollar peg. Conversely, when people start selling their stablecoins to buy whichever crypto is currently going to the moon, this sometimes manages to push the price of stablecoins below $1. When this happens, stablecoins are burned to reduce the supply, thereby raising the token's price to put it back in line with its dollar peg. Whereas crypto-backed and algorithmic stablecoins have automatic and incentive-based systems which mint and burn tokens to meet demand, fiat-backed stablecoins rely on the companies which issued them to do this. In theory, the companies which issue fiat-backed stablecoins have an equivalent amount of dollars in the bank to back the tokens in circulation across all cryptocurrency blockchains. When fiat-backed stablecoins are minted, this means that someone somewhere went to the company behind that stablecoin and gave them dollars in exchange for tokens which are then put into circulation. When fiat-backed stablecoins are burned, this means that someone somewhere went to the company behind the stablecoin and gave them tokens in exchange for dollars, which then takes those dollars out of circulation. Having this one-to-one ratio of dollars to tokens is extremely important because if there was ever a black swan event that caused everyone to cash out of crypto, not having sufficient dollars in the bank means not everyone would actually be able to convert their digital dollars into physical dollars. As I mentioned in the introduction, fiat-backed stablecoin issuers have historically not been very transparent about whether their tokens are fully backed by dollars. This has led to a lot of stablecoin competition in the crypto space, with each new fiat-backed stablecoin company claiming that its tokens are backed by more dollars than its competitors' tokens. The three largest stablecoin issuers have all recently revealed these details, which means we can finally assess which of these stablecoins are legit and which ones are backed by nothing more than funny money. USDT is the largest stablecoin circulating in the crypto market and is issued by Tether. Tether is based in Hong Kong and is closely affiliated with Bitfinex, a Hong Kong-based cryptocurrency exchange. Just how tangled up these two are is outside the scope of this video, but you can find out more about that by watching another video I've linked up there in the top right. Anyways, Tether was founded in 2014 and its USDT stablecoin was originally built on top of Bitcoin using the OmniLayer protocol. Today, USDT exists on Omni, Ethereum, Tron, EOS, Liquid, Algorand, Solana, and even Bitcoin Cash via the Simple Ledger protocol. About 50% of all the USDT in circulation exists on Ethereum as an ERC20 token, though apparently there have been no new USDT tokens issued on Ethereum since May. If you're wondering how Tether makes money off USDT, the answer is fees. In addition to a 0.1% cut of all fiat deposits and withdrawals, Tether charges $150 for KYC verification, which is required to mint and redeem USDT and the other stablecoins it offers. Initially, Tether stated that USDT was backed one-to-one by US dollars in a bank. This changed in March of 2019 when Tether rewrote the collateral clause to include, quote, other assets and receivables from loans made by Tether to third parties, which may include affiliated entities. Tether keeps track of the assets backing its various stablecoins on the transparency page of its website, which is updated every day. As you can see, there isn't very much detail here. Nobody really knew what was backing USDT until mid-May this year, when Tether released a breakdown of its reserves as part of its settlement agreement with the New York Department of Justice. According to Tether, the USDT in circulation is backed by the following assets: 76% cash, cash equivalents, short-term deposits, and commercial paper, which is divided into various categories in that orange pie chart. As you can see, it's mostly in commercial paper, with just a sliver in cash. 12.5% secured loans, 10% corporate bonds, funds, and precious metals, and 1.5% other assets including digital tokens, aka cryptocurrency. I'll explain what each of these mean in a moment, but first, let's see what Circle and Paxos are packing. USDC is the second largest stablecoin circulating in the crypto market, and it's issued by Circle. Circle is based in the United States, specifically Boston, Massachusetts. Circle was founded in 2013 and has raised over $770 million from big names such as Goldman Sachs, Bitmain, and Digital Currency Group since that time. In October 2018, Circle partnered with Coinbase to form the Center Consortium, which governs the USDC stablecoin. USDC was initially issued as an ERC20 token on Ethereum, and this is where most of its circulating supply remains. USDC can also be found on Algorand, Solana, Tron, Stellar, and probably a few other blockchains that I can't remember off the top of my head. In my defense, the Center Consortium has been pushing to get USDC on as many cryptocurrency blockchains as possible, and they recently announced plans to deploy on 10 additional crypto chains. In contrast to Tether, Circle seems to make most of its money from payments made in USDC, something which can now be done via Visa thanks to the partnership they recently penned. Circle has zero fees for bank transfers and also no fees for exchanging US dollars for USDC and vice versa. This is one of the many reasons why USDC has been growing at a faster rate than USDT as of late. Another reason relates to the transparency reports around the assets backing USDC, which can be found on the Center Consortium website. Grant Thornton, one of the largest accounting firms, provides attestations of the assets backing USDC on a monthly basis. Historically, these have not been very detailed and have provided about the same amount of information as Tether does on its transparency page. However, in late July this year, Circle released a detailed breakdown of exactly which assets make up the dollar amount that's backing USDC. If you're wondering why now, the answer is that Circle is preparing to list on the stock exchange in a SPAC deal, and they want to be as transparent as possible for regulators and both current and future shareholders. According to Grant Thornton, the USDC in circulation is backed by the following assets: 61% cash and cash equivalents, 13% Yankee certificates of deposit or CDs, 12% US Treasuries, 9% commercial paper, 5% corporate bonds, and less than 1% in municipal bonds. Not bad, but not what most people were expecting, which is why Paxos took the opportunity to show just how solid its stablecoin is. BUSD is the third largest stablecoin circulating in the crypto market, and it is issued by Paxos. Paxos is also based in the United States, specifically New York. Paxos was founded in 2012 and has likewise raised hundreds of millions of dollars over the years. Now, most of this money came from lesser-known investors, but this list includes payment giants like PayPal. Fun fact, Paxos actually custodies the cryptocurrencies being bought and sold on PayPal. BUSD is technically a branded version of Paxos's less popular Pax stablecoin, which went live in 2018. BUSD is the product of Paxos's partnership with Binance in September 2019, and it exists on Ethereum, the Binance chain, and the Binance Smart Chain. All the assets which back BUSD are custodied by Paxos. Like Circle, Paxos does not have any fees for the creation or redemption of its stablecoins. Now, Paxos likely makes most of its money from providing crypto custody and crypto trading services to institutions. Also, like Circle, Paxos publishes monthly attestations of the dollars backing its digital token, and these are done with the help of Withum, a, quote, nationally top-ranking auditing firm. Paxos's asset attestations have likewise been very vague until last week, when Paxos pounced on the opportunity to flex how much better Pax and BUSD are backed compared to USDC. According to Withum, 96% of all Paxos stablecoins are currently backed by cash or cash equivalents, with 4% being backed by US Treasuries. And now for the big question. What the hell are all these assets backing the largest stablecoins, and what makes them good or bad? Well, let's start with the assets backing Tether's USDT. Note that I'll keep this super simple so as not to break anyone's brain, including mine. Starting with the small pie chart, almost everything that's mentioned there is basically debt of some kind in the form of a loan to a public or private institution. Treasury bills are short-term government debt. Reverse repo notes can be stocks, but in this case, they're probably debt. Cash is, well, cash. Fiduciary deposits are assets held in another bank on your behalf. And commercial paper is unsecured short-term corporate debt. In the bigger pie chart, secured loans are, of course, debt. Corporate bonds and funds are again debt, though precious metals aren't, which makes me wonder why they're lumped into the same category. And last but not least, other investments including digital currencies, which is probably Bitcoin. It's a similar story with Circle's own collateral. Cash equivalents are actually short-term debt, and the reason why they're called cash equivalents is because they're easy to cash out. Go figure. Yankee CDs are loans to foreign banks denominated in US dollars, aka debt. US Treasuries are debt. Commercial paper is risky short-term corporate debt. Corporate bonds are safer corporate debt, and municipal bonds are local government debt. Finally, we have Paxos's reserves, most of which are again some form of public or private debt and probably include a nice chunk of cash. Now, if you're wondering why all these stablecoin companies are holding so much debt, the answer is interest. If you're sitting on billions of dollars in cash and you know that all your customers probably aren't going to come asking for it back at the same time, lending money to private and public institutions is a great way to earn interest on that cash. Even though most of the cash being loaned out by these stablecoin issuers will only earn a few percentage points per year, that works out to a massive amount in dollar terms when you're dealing with that much capital. It's also not a big deal so long as the assets you're investing in can be quickly changed back into dollars at a moment's notice to pay back any customers looking to cash their stablecoins out. Now, this brings me to the final topic, and that's which of these stablecoin backings is the best. For starters, it's important to note that Tether's account of what's backing USDT should be taken with a grain of salt. That's because they simply posted a pie chart without oversight from any accounting or auditing firm. While Paxos and Circle do provide attestations of their reserves on a monthly basis, an attestation is not the same as an audit. An attestation is just when a third party verifies the information being shown to them. An audit is when a third party actually goes digging through all the paperwork to see what's not being shown to them. Now that said, Paxos apparently does get audited from time to time, and this is because it's a trust company regulated by the New York Department of Financial Services, or NYDFS. Although none of these audits seem to be posted on Paxos's website, its status as a trust company means that Paxos can only hold assets that are safe, liquid, and insured in their reserves. This is the biggest difference between Paxos and its two contemporaries, and it's also why such a large percentage of Paxos's reserves are made up of cash and cash equivalents. Even if all their cash equivalents are debts of some kind, they are a form of debt that can be quickly redeemed for dollars, regardless of market conditions. This means that people who hold BUSD or Pax can know for sure that they can cash out even if the crypto market is collapsing. If it wasn't obvious already, the type of debt that lies at the opposite end of the safety spectrum is commercial paper, whose safety ultimately depends on the company which issued it. Almost 50% of Tether's reserves are commercial paper, and there is, of course, no way of knowing which corporations it came from. The origin of Circle's commercial paper is also unknown, but the bigger issue is that the other assets it holds are not nearly as liquid as cash equivalents. This means that in the event that the financial markets are crashing across the board, Circle could be 10 to 25% short of the dollars it needs for its customers to cash out in a timely manner. Funnily enough, Tether doesn't have this problem because its legal disclaimer notes that, quote, Tether reserves the right to delay the redemption or withdrawal of Tether tokens if such delay is necessitated by the illiquidity or unavailability or loss of any reserves held by Tether. And that, quote, Tether reserves the right to redeem Tether tokens by in-kind redemptions of securities and other assets held in the reserves. In other words, Tether doesn't guarantee redemption of USDT for fiat at all. So if you go knocking on their door when the market is crashing, don't be surprised if they give you crappy corporate debt instead of dollars. Stablecoins have been contentious cryptocurrencies, and it's easy to see why. The lack of transparency from the companies which issue fiat-backed stablecoins is astounding, to say the least, and I reckon regulators have reasons to be concerned. If you still don't understand why, imagine what would happen if Tether, Circle, and Paxos invested hundreds of billions of dollars into regular markets with their stablecoin collateral. If the crypto market crashed and everyone came running to redeem their stablecoins, this would cause an unbelievable amount of sell pressure for whatever assets these stablecoin issuers are holding. If most of that money happens to be sitting in assets like home equities, it could potentially crash the housing market and bring the stock market down with it. While this might not be a risk today, at the rate that fiat-backed stablecoins are growing, it will be a risk sooner rather than later. My only hope is that someone will develop a robust algorithmic stablecoin that will do away with the need for collateral altogether. On the bright side, it's extremely unlikely that governments will ban fiat-backed stablecoins anytime soon. They and the corporations they bow to need someone to buy all their debt after all, don't they? If you enjoyed this video, let me know by turning that like button blue. Be sure to subscribe to the channel if you haven't already, and ping that notification bell to get a nudge when the next video is ready. Feel free to follow me on Twitter, TikTok, and Instagram, and drop by for some daily crypto updates on Telegram. The only thing better is my weekly newsletter, and if the tools, tips, and tricks I give you there make you some extra gains, consider using them to get your hands on a nifty tee or sweater. Crypto swag like this and more only at the Coin Bureau merch store. You can find it using the links down below, along with my socials and newsletter. That's my 2 cents for today, folks. Thank you as always for watching. Remember to keep calm and hodl on. Guy over and out.